was that? Fire alarm?
I I don't know what that was. I think that was a big boat or something like that. I'm not sure.
Yeah,
The
that's
water's right
quite the
there.
odd.
I'm gonna assume it was a boat, not a fire alarm. It stopped going off, but it looks like we are live. What's going on, everybody? Welcome back to Wolf. It's great to see all of you here. We've got Mr. Robert Infra, as always, in the house talking macro. If you like the macro conversation at all, a lot of our spaces have started to move into that direction. You're gonna want to make sure you give Robert a follow. He is all over the place, going on all sorts of streams, spaces, podcasts, like literally all the things. And brother is active, dude. That's what I'll say. He's active. He posts YouTube videos and stuff like that as well. So if you like this discussion, there's a whole lot of it out there for you to get. And I think it's worth poking into because, as these markets develop and, like the capital markets start to flow together, we had a really good discussion around Bitcoin and gold and, what was the right asset to be measuring things in? Does it make sense to I think it was actually an interesting conversation, Robert. I wish you were there for it, actually. But it was a discussion based on like, should you be using gold as a like benchmark kind of thing because of its recent big outperformance scandals? And like the discussion was kind of based around like, well, you should because that's part of it. Other people were saying, well, like this recent pop sort of invalidates that you shouldn't be using it as closely, just because it's kind of like a once in a decade, once in a 20-year type of pop sort of thing. And so it was a really interesting discussion. Like a bunch of people popped into that space. Benjamin Cohen was in that space for a little bit. Like it got kind of crazy. It was yesterday. I was like in the airport trying to fumbling around doing all this stuff. It was a disaster. Like I wish I was locked in for that conversation, but there's a whole lot of things going on. And so I'm excited to be chatting with you about it. Also, I sent you the link, Robert, on the private chat if you wanted to reshare. And for everyone who's out there listening, if you haven't already, please take a second and repost the space or repost the stream. And we're going to roll into this. Definitely be sure to give Robert a follow. Robert, I was going to ask, well, actually, if you have any thoughts on that, just first off, like, does it make sense? Because you've talked about this as well, especially with Bitcoin, measuring it against gold. Now, gold has had a crazy run. Does it make sense to pair it to gold now? Or does it make sense to kind of wait and see where gold sort of figures itself out? Like, is there a true value here? What are your thoughts on that?
Yeah, I think, using gold as a denominator hour to hour, day to day is probably not super useful. But over long periods of time, years, decades, I think that we should. But yeah, especially like we've seen recently on a day to day kind of basis or hour to hour, it's a bit difficult to denominate your life in gold. I do think that comparing like Bitcoin divided by gold, I think that sort of thing, comparing apples to apples in terms of performance, I think that is definitely worth keeping an eye on. I think that the way that Bitcoin has underperformed gold is definitely, definitely something to keep an eye on. It's definitely a ratio that I watch. But on an hour-to-hour basis, like in terms, of my wage, right? Like how many ounces of gold am I earning per hour of work? That sort of thing, not super useful to watch on an hour-to-hour, day-to-day, week-to-week sort of thing. But I think over years, over decades, that sort of thing is useful. But yeah, comparing Bitcoin to gold in terms of performance, like you got to ask the question, why is gold outperforming Bitcoin to such the degree that it is? I think that sort of thing is definitely worth the question being asked.
Yeah, 100%. Also, one other thing here, and and by the way, if you want to share a screen at any point, definitely, especially as we're pulling up different charts and pairing them against each other and stuff, definitely feel free to do so. I'll pull one up here. I just saw Rajat Soni tweeted this out. Big Bitcoiner in the space. He was talking about STRC. We had Michael Saylor go on yesterday. I saw a bunch of tweets that were not happy with Michael Saylor just because I guess they didn't want Saylor to talk about, I guess he mentions like a liquidation price. Like we went down to like 90%, we'd have to refinance, and that would be a good situation. Of course, if Bitcoin went down 90%, like we got a big problem. 90% is quite a big drawdown. But STRC is up 6.5 or almost 7% in the last week. It's above, just now below $100, but right around $100. I don't know. I guess we've done a little bit of discussion on STRC and some of their other plays. We've talked about MSTR as well. Do you have any thoughts on like? I'd love to get some of your thoughts more on like the MSTR ecosystem as a whole. We talked about MSTR a lot, but they've got other assets people can invest in for more income and things like that. Tell me where you're at with MSTR right now.
Yeah, I saw that clip where he basically said, "Oh, well, don't worry about it. We'll just refinance
Yeah.
if Bitcoin drops."
What do you
And
think about
the CNBC host was like, "But you think banks are gonna want to refinance and issue that loan if because it's kind of like a if then this
that? Right.
if Bitcoin falls tremendously, well, that is the collateral. So if Bitcoin is falling, to a 50% or something kind of unforeseen, then by definition the collateral is falling in value. And like, what bank is going to go rush to provide dollars when the thing is collapsing? The asset that the company holds, that asset is collapsing in dollar terms. It to me, it's not that radical of a question to ask, but he kind of got a little bit uncomfortable. I think that yeah, the anytime that I've always been a little bit kind of iffy, not fearful, but the way that he talks sometimes in kind of absolute terms
Yeah.
can be a little disconcerting. Yeah, MSTR, the chart looks ugly. I mean, I do think that we're probably close to a low. But yeah, when it comes to the other products like Stretch and that kind of thing, again, it kind of, for me personally, it comes down to Saylor and trusting the complex, trusting Saylor, number one, MSTR as a company, number two. And I don't know. I mean, I haven't done like a ton of research on the preferreds and the various products, but that's just due to the fact that he kind of sketches me out.
Yeah.
You know,
It's honestly a tough one. Like that's actually a really good way to put it. Like he does speak in these absolutes, and it's so funny like how price front runs the narrative, right? Like Michael Saylor talking about Bitcoin being digital credit sounds real good when Bitcoin's winning. Sounds real good when Bitcoin is winning. When Bitcoin's not winning, him saying the same thing is kind of like, dude, stop saying that. Like, it's so funny. You're like, this is not what they want to hear right now. And I think a bit of context matters as well, like which show you're on, the level of expertise that the hosts have as well. And also interest. Like sometimes he'll go on and they're kind of hostile. They're just hostile.
Yeah.
And I'm like, dude, you got to pivot a little bit, I think. I'm not sure. I mean, he's also low key like the best we've had for like a spokesman in terms of Bitcoin for a long time. He's been a pioneer, obviously, in the space as well. Real quick, but before we move on, or before we continue on this one, one thing I wanted to pull up here, which I thought was interesting, and also a big shout out to RexShares for sponsoring today's show. But there's a couple different ETFs I think are really interesting. If you guys are in this game, and RexShares has a bunch of really cool ETFs. One of them is MSTU, double X long MSTR. There's also a MSTZ, which is a inverse MSTR daily target. I don't know. I thought these were interesting because if you're trying to trade these markets and you're confident you're trade, these are wild, dude.
Like going back to July of last year, the double X inverse is up 418%. And it was up even more. It was up at the peak. It was up 800%. That's crazy.
No, I'm telling you, dude. Like if you understand how to trade these markets, there are so many different, just different assets you could get into. You could stay with like the MSTR, but if you're like really confident, you're like this thing's cooked or this thing's about to send. Like there are opportunities to double up here, and multiply your profit. It's the same with like copy trading. Like when you've got like a prop firm or something like that, and you've got multiple accounts, you're like, hey, I know this is going here. I'm very confident. I'm going to take 5 different accounts trade. You can 5X here. So anyways, I thought it was really interesting. Big shout out to RexShares for sponsoring today's show. A couple ETFs to throw at you to kind of just throw into the mix, at least add to your watch list. If there are some assets that you guys are very in the know about, there's oftentimes a lot of ETFs, whether they're single stock or if they're like a conglomerate of different stocks and stuff. There's a bunch of opportunities out there, especially for those who are trading. Also, that link, if you guys want to check out RexShares, is in the tweet below our stream. and it'll be in the description if you're watching on YouTube. I do need to say this just because anytime you work with ETFs, you got to make sure you throw this in there. An investor should carefully consider a fund's investment objectives, risks, charges, and expenses before investing. The fund's prospectus and summary prospectus contains this and other information about RexShares. And if you want to obtain their prospectus and summary prospectus, visit their site at rexshares.com. The prospectus and summary prospectus should be read super carefully before investing, of course. But we are very excited to work with RexShares. They're one of our longest running clients. Again, that link is down in the one below us. But yeah, dude, crazy stuff, man. Like so many opportunities in these markets, an enormous amount of things you can trade.
Yeah. Speaking of high conviction bets, I was in some SPY puts this morning. I was like very, very confident. And so I got some SPY puts earlier in the morning, and they have just completely like 15x'd.
Damn, dude.
Yeah, it's crazy.
Every now and then I'll be scrolling the timeline and I'll see Robert have a comment below on someone being like, man, this market's cooked. And you'll be like, I think this is a skill issue. And you'll just put a screenshot of the current portfolio. I'm like, this brother is trading these markets, dude. This guy's active.
That was a joke. I didn't realize that they changed the algo, like where your replies get shown kind of even
they do.
if the
like,
person.
I see a lot.
I figured, oh no, none of my followers follow that guy, and so no one will see it. You know, it's just kind of a S post. But then
boom, roasted.
A lot of people. Yeah, look, I think trading is fun, and I think that a lot of people find entertainment value in it. I would just caution, like I keep that trading portfolio very, very small. And it's a very kind of small percentage, like looking at MSTU or the inverse one, those kind of things, like people, I think the key for, and again, I'm not a, licensed financial advisor or anything, but like, I think the approach that I see, in irresponsibly long and those kind of groups, like where I see people, normal people get into troubles when they size way too big. The position sizing is everything, like I think that like when I trade options, especially, short dated options, I assume it could go to zero and it wouldn't bother me. You have to position size appropriately. And if you do, I mean, the chart looks pretty crazy, right? When you zoom out, probably, decay and whatnot. But look, like if you want the exposure, you want the entertainment value, or you want the exposure for whatever reason, maybe a hedge to your long Bitcoin or something, just size things appropriately. I think that like 99% of emotional distress that comes with markets that I see, normal people suffering with, all comes down to position sizing. And so I think that's why I like options over futures or other instruments. Is options give you defined risk, right? I mean, if you're just going long or just buying calls, just buying puts, you can only lose whatever you put in. And so it'd be the same thing with something like this. Just position size appropriately. Assume it could go to zero. And as long as you're okay with whatever you're putting in going to zero, then you shouldn't have a problem. The problem gets in where people get levered, like in irresponsibly long. I don't know how that guy's doing, but some guy took out a reverse mortgage on his house back here in late 2024, I guess it was, when it was gapping up parabolic every day. He took out a mortgage somewhere up here, a reverse mortgage, and put it all in MSTR, and he's down bad.
What is a reverse mortgage for those who are listening? They don't know.
Well, you're basically borrowing against your house. It might have been the HELOC or something.
Which is, by the way, a wild thing to do. Just period, point blank.
Yeah, especially to put it into like a super volatile asset, that is gapping up every single day, going parabolic like that. I mean, the chart at the time was something like this, and it was just stunning. And it reminded me a lot of the kind of AMC GameStop craze, that era in 2021. And that was part of the reason that I did call the top to the day on MSTR. part of the reason was the peak in euphoria, and you saw people doing just wild stuff like that. People with crazy price targets. Oh, MSTR is going to $5,000 per share, that kind of thing. And I'm sure that he was not sleeping too well for the next couple weeks. So don't, if you're going to use leverage, just my personal advice to myself, I guess, if I'm going to use leverage, do it responsibly, and manage risk. Like, it all comes down in markets to risk. And so as long as, if I'm going to use leverage, which I don't very often, my primary concern is going to be managing that risk. And I think a lot of stress that I see with everyday people comes down to risk management, and it's difficult, right? It took me years to even have a concept of it. But yeah, but that's really the key. And at the end of the day, like, I don't take any happiness or anything from MSTR, because average people got hurt. A lot of the people in that group were doing some really irresponsible things, and they're normal people, right? It might have been their life savings or something. It might have been 6 months worth of their pay, their income, that kind of thing, and it's just like watching people like that get burned. It's unfortunate because it doesn't have to be that way. Just if you're not super experienced, you don't know, if I say the word risk management and you don't immediately know what that means and kind of have a framework already in your mind of how you manage risk, then positions like, just assume anything you put into the market, especially if it's levered, can go to zero in size appropriately. And once you do that, you will sleep so much better, in my opinion. Again, just my personal advice to myself. I think
so
that
question, like, that's a great point. Like, and that's why we started, like, I'm pretty careful now when we have spaces, because I didn't realize how many people do listen, and people will take financial advice off a random singular take off a space. And so you actually do need to sort of like monitor what's being said a little bit. And if someone starts saying something way off the wall, like, the speakers and like people in the audience almost have to check them, just out of like their own respect, almost. Because it's like, yeah, like you mentioned, like, there was some crazy behavior happening. Like, I remember it, and it's crazy because when it's happening, you don't really realize it until like kind of like way after. Like, now we're looking way back, and like the chart looks absurd. You're like, how do you know? Like, how it was so obvious, and you're looking at it, you're like, well, at that point it wasn't. Like, at that point, like, I don't know. Maybe you could explain a little bit more on, because you called the top of the S&P a while back as well, or like just like the macro, like literally the entire macro.
Oh, December 2024.
That was right.
Yeah,
right.
December,
And then MSTR's top. Like, what was it at the time that you were like, okay, yeah, we're cooked. Like, this is, like, how did you know? What were some of the things that you were thinking about and seeing?
Yeah, I totally forgot about that S&P call. That was was almost to the tick. That was pretty. Forgot about that. Yeah, it's just like with MSTR, it was the parabolic run. That doesn't happen. Well, it can happen, but it's not going to go on forever. So when you see something, and the same is true in the other direction too, as well, which is things don't go down vertically forever. Their market now, maybe, if you're talking about a micro cap company that is, on the verge of bankruptcy, like, those can go to zero, and those can go vertical forever, and go to zero. But generally, you're talking about something, a large, the S&P 500 or Bitcoin or something like that. It's when you see that kind of parabolic rise, when you see the corresponding sentiment get to an extreme. With MSTR, it was obviously extremely bullish. I also look at volatility. So if you go back to that, I think it was November, that period of time on MSTR, the volatility was like, I think an at the money 30-day call was like 500 or something. I mean, it was absurd. And so that volatility can also be a pretty good indication of, eventually insurance, think of volatility as insurance. Eventually volatility sellers are going to go, oh, that's pretty appealing. I'll take that risk. I'll sell, upside on 550 asset, which happened to be MSTR. And they did. And they did, and they crushed volatility. And so not only if you were buying calls back here during kind of the parabolic run, you were paying for volatility. Volatility is one of the main inputs on pricing an option. And the higher the volatility, the more expensive, right? Because if something is making 20% moves every day, then the volatility that's priced into that option is going to be very high. And the likelihood that the option hits, goes in the money, hits a strike and goes in the money is going to be very high because the thing is making 20% moves. Well, now think of the opposite. If the thing doesn't move, it goes straight sideways, there's no volatility. Well, the likelihood of it making, a large move up or down is pretty low. And so that option is going to be cheaper. There's other components, right? Delta and stuff, but generally, that's the way to think of volatility. So yeah, when you get a super large increase in volatility like we had with MSTR, what eventually happens is, the incentive then is for short vol traders to come in and sell calls and sell puts. And as you pile that on for a couple days, for a couple weeks, and we saw the volatility just collapse from, I think it was like 550 or something, down to I think like 150. So not only if you bought calls, not only had you paid when you bought the contracts, paid a huge premium because volatility at the time was very high. Not only did the volatility collapse and therefore your calls lost a lot of premium, lost a lot of value. Not only that, but the stock price went down too. So the likelihood of your crazy far out of the money 950 strike call option getting in the money went plummeted. And so, some of those short dated call options back here plummeted like 90% in value here. Because not only did the implied volatility collapse, but you also got the share price decline by 45%. So I would say volatility can be a useful, way of looking at it. I would say, longer term RSI can be helpful, right? If the weekly RSI is like 10, you're probably very near a bottom. I try not to like make too many decisions or calls off of like 15-minute charts. I think longer time frame, daily, weekly, monthly, that kind of thing is probably better. You don't want to be catching a falling knife.
Sure.
Well, the 5-minute RSI is oversold. It's like, okay, but it can go further on the daily. So RSI, when you see those kind of parabolic waterfall kind of moments, and you generally also see a spike in volume. So like, for example, this was the day, and this morning in a space was the day that I called MSTR's top. It had gapped up huge over the prior day close there. So that's what, at least 5% move that it gapped up overnight, right? So when you see those huge gap ups, that can be another indication. Gapped up 13% from the prior day's close. And you had seen volume already kind of come in way above the norm. So the yellow line here is the 14-day average of volume on the daily. And so, yeah, you had already seen almost double the 2-week average in terms of daily volume. That you're starting to get into like capitulation territory where everyone that can buy has already bought. And the only thing left is for sell. The same thing with Bitcoin on the way down, right? Like when we saw that kind of waterfall sort of price action, you saw a huge spike in volume. That is kind of an indication of like a capitulation where volume spikes. Everyone that could possibly sell or buy in the case of MSTR has bought or has sold. And the only other direction is for it to go the other way. So huge, spike in volatility, huge spike in volume, kind of parabolic, or waterfall, to the downside, that kind of price action, all those kind of, and sentiment, of course, right? Like people were in the days leading up to that, people were talking about like crazy price targets.
Yeah.
$3,000, $5,000 per share. I mean, it was nuts. Especially given it had already gone parabolic. It was trading, with MSTR, you could look to fundamentals like the MNAV, which was already quite high back here in early to mid November is already quite high. So all those things together, it's never any one indication or indicator or metric, but I try to kind of look at it holistically. And when you see everything like that lining up
Yeah.
at the same time, you're probably pretty close to.
You're like the only. I mean, I'm sure there were others, but you were like the level-headed guy when all that was happening. I remember in our spaces, like things. It was just like high after high after high after high, and we were just like, man, like, what is this thing? Like, we are going to full set, and like you said a few minutes ago, like there's just no way, like in the middle of it, you can't see that zoomed out chart yet of how it's performing, compared to in a year from then. But man, I mean, it's been pain literally ever since. Like a couple of rallies here and there, but like not really. I mean, it's been pain.
And I would much rather, generally you want to buy when people are like, oh, this thing's going to zero, sentiment is fear and greed is negative, right? And that sort of thing. Generally, like those are where I like to buy something. And when people are, oh, this thing's gonna do a 20x and go to an 18,000 MNAV, that's where I would probably be selling. Like maybe you don't want a taxable event, selling your MSTR shares, but you can sell upside calls and capitalize on the huge volatility that was being priced in. Capitalize on that, and those calls are going to expire, worthless very quickly. It only would have taken like a week for those covered calls to basically, go to zero, and you pocket all that money. And if you have a long-term, conviction on MSTR, you just hold your shares. Maybe you sell upside volatility, sell calls kind of along the way or something. But yeah, I mean, it was is not something that I would want to go long. Right? You don't want to buy the top of a parabola. You don't even really want to buy the parabola. The problem becomes like where's the top, or where's the bottom. I mean, this happened with silver, right? Where like a lot of traders and a lot of people that have been in markets a while were looking at silver and like, yeah, I want to touch that with a 20-foot pole. But the problem is a bubble can always get more bubbly. So trying to short it is a totally different calculation than just looking at it and be like, this is kind of bananas, I'm not going to touch it. You have to equally know when to just watch it, right? Like I saw silver. We were talking about it all the time, every day. It was like all anyone was talking about, and I was watching it all day. But you got to recognize the times where you're just, I'm just not going to touch it. I can watch it. I don't have to be buying and selling this particular asset. And I have my silver from 2022, 2023, whatever. I'm just going to hold it and watch, right? Like you don't always have to participate in the hot trade, whatever that is. If it's MSTR back in November 2024, or whether it's silver recently, you don't have to always participate. You could just watch it and kind of know when to just step away and kind of just watch it, let it do its thing. I mean, Bitcoin, for me, I wasn't buying from, I think it was like Liberation Day, April, May time period. Once it started to kind of move higher, I don't generally like to buy something that's moving higher, especially given kind of what I was seeing develop in like the repo market and liquidity issues and carry trade. And there were a number of issues that I was kind of watching during this period of time. But yeah, like I generally like to wait. And I'm glad I did. This entire period, I kind of just built cash, paid off a lot of debt. And now, now when everyone is like, oh, dump this thing, it's going to zero, I can scoop it up at a discount. And so that kind of framework is generally how I try to look at it. And like with Bitcoin, we saw everything line up, right, with a capitulatory low, which was you had that waterfall kind of parabola to the downside. You saw a huge spike in volume, and I didn't nail the bottom, but I got pretty close. And yeah, maybe it takes another leg down, which is totally possible. But the good news is I was not buying at 120K, because I think that's the other thing that no one ever talks about is what is your cost basis? If your cost basis on Bitcoin is, I don't know, $5 per Bitcoin, you're not really gonna care if it goes from 120 to 100 or
Yeah.
whatever. And so that's something I think people need to talk about more when it comes to position and their view. Because if I'm, if my cost basis on Bitcoin was 125K, I would be in a lot of pain. I would be
Oh
pretty
yeah.
miserable. I'd be pretty bearish. I'd be feeling it, right? But it's not. For me, my cost basis is like 52. Last I checked, 52, 53, something like that. And so there, it's a totally different calculation for me to add at, 60 or whatever,
Yeah.
whatever it may be, than if my cost basis was 120. Or, and, in the other direction too, if my cost basis is $1, right? If I was pressing the Bitcoin faucet every
Oh, yeah.
day, getting free Bitcoin, I wouldn't, I don't know. I probably wouldn't care nearly as much. I
And it's
might
the
sell.
Bitcoiners in a lot of the spaces. I mean, those guys have been in for a couple cycles, which means they've been getting in at a 3-4 digit Bitcoin. That's why they're so convicted. They're like, brother, and as they should be. If you bought in at $1,000 Bitcoin, like you should be good with you being up 50x, 60x, 100x. Like you should not be worried. So like it makes total sense that they're not. It's just tough because you have like sometimes it's difficult because in their head they're like, look, this is what I went through the same thing. Back then it was $4,000 and the risk was at 15K or whatever it was. And it's the same conversation now. It's just different numbers. But if your average price, like you said, is 125K and you saved up $50,000 over the course of a year to finally buy, however much, like half a Bitcoin or a third of a Bitcoin, and now you're down 50% on your investment.
Totally different story.
And that's just pain. And like, you could hold for a few years, but
well, that's
I don't know.
That's the key. That's the key. Like when it comes to, Bitcoin, for me at least, I don't look at it hour to hour or month to, day to day kind of thing. I look at it as a 10-year, 20-year, 30-year sort of thing. There will eventually come a time to sell Bitcoin to buy, sell Bitcoin to buy dollars. That moment could very well come. It's not anywhere on the horizon in the next couple of years, in my opinion, but it could always come. But I'm looking like at literally like a decade or two out.
Right.
So volatility, like volatility where Bitcoin's coming down back down to 60. Like I just think that that's mispriced. I think that 10 years from now, 60K Bitcoin is going to look very good. Like, is 60K Bitcoin going to look very good a week from now? Maybe not. Maybe I've been like the only public bull on Bitcoin, apparently, it seems like. And I've been buying.
The last one holding the line.
Yeah, I've been buying this kind of leg lower. Maybe a 60K or 63 or 65. Maybe that doesn't look good in a week, right? Like it can always go lower. It looks like IGV is going lower, despite the fact that you kind of had an argument to be made for a bottom here, a short-term bottom with short sale volume spiking volume underlying volume 3x the 2-week average and kind of the same waterfall sort of price action. Looks like IGV is going lower, so Bitcoin's trading with a correlation to that. So maybe Bitcoin goes to 50K, but like people that are well, you bought at 60 and now it's 58. It's like for my time horizon, which is 10 years, you can't even see that. You can't see that, the difference between 60 and 58. So I think that time horizon and cost basis are two of the kind of least appreciated or least discussed metrics that people should kind of always talk about when they're giving their view on a particular asset.
Yeah, no, that's a good point. Well, one of the things I wanted to pull up was here.
Wait, I wanted to show one thing. So look at ARK. So this is ARKK. This is one of the things that topped basically at the same point that Bitcoin did here in kind of October. So this is ARK on the daily, and then this is Bitcoin. Obviously, Bitcoin's going to have more candles, so you have to adjust for that. But generally speaking, it's the same chart. ARKK here going back to October, and Bitcoin going back to October.
Wow.
So yeah, the high beta corners, software's getting pummeled for sure with AI fears. But ARKK, the quantum names, right? QBTS and all these kind of things, they're getting brutalized. Going back to like October, mid to late October was kind of when everything started to really roll over. It's not just Bitcoin. This is
Yeah.
Qubits. What's the other one? D Wave, I think. D Wave. All those quantum names, I was looking at them earlier. They're all getting hammered. So it's not, oh, Ionic. It's not just Bitcoin, right? It's the kind of high beta, sort of more speculative areas of the market are just not doing well right now. But again, I think that that's mispriced because my time horizon is 10 years, right? Like, could they all go lower over the next week, 2 weeks, month, whatever it may be? Absolutely. And that's why I think it's always important to have some cash, to have some dollars, so that when these sort of opportunities present themselves, you have a bunch of cash to deploy. And so, if Bitcoin does go lower, breaks that the low that it made here, it's totally reasonable. I could, I'm not going to time it perfectly, but I will at least have cash to buy much more than I could have bought at 100. And so it's just kind of how I think about it.
Yeah, and I see Lanny here in the chat. He says that Lanny's feeling comfy. He said, "Why sell Bitcoin when you can leverage it as an asset now and even more so in the future?" And Lanny's also actually he's been in your corner a little bit, Robert, as well. Like we've obviously we keep tracking the trading spaces on how Bitcoin's doing, day to day and week to week on the TA side of things. But he also talks about all the time. He's like, every single time I make a profitable trade, 50% goes to Bitcoin, whether it's at 126K or 20K. He goes, it pretty much makes no difference to him. And so, yeah, there's a couple guys here in corner, Robert, but I will say it's definitely dwindled down. Do you have any thoughts on so Coinbase has I believe that's Q4 earnings today,
Oof.
and they're down pretty bad, 8% today, just holding $140. Their week is down around 3.5%. In the month they're down 40%, dude. I mean, Coinbase has taken a absolute beating, 50% in the last quarter. I don't know if you have any thoughts on Coinbase, but I don't know, dude. I mean, that's rough. Like that is, I don't know if it can get. I mean, it can get worse from this, but like we're at a decent spot here where I'm like, has most of the pain been already priced in? I was just speaking with Paul from Themes ETFs and Leverage Shares, and he was on the space actually the other day with us. And he mentioned that Hood had a lower amount of like monthly users and a couple other things that may be factored into their recent price action. So that's something I'm going to be paying attention to see how Coinbase is doing on users every month and if it's going down. Or I'm not sure what your thoughts are on Coinbase though.
Yeah, it's kind of, we were talking with Joseph the other
Yep.
day about it. I think prediction markets are eating a lot of the flow that would go to Robinhood, stock options trading, crypto, that sort of thing. I think the younger crowd, prediction markets is where they are right now. It is what it is. We cannot like it, but
Yeah.
I think that that's probably, and it's true for Bitcoin. Robinhood and Coinbase basically trade. They basically trade kind of somewhat in line with kind of the broader crypto market, just because so much of their traffic, of their flow is in kind of the retail, more speculative kind of corners. So when Bitcoin dumps, you generally see Robinhood's not doing well either. Yeah, I think the other problem too, not only prediction markets kind of eating the lunch, which both Robinhood and Coinbase are trying to get into. I have both Robinhood and Coinbase, and like I've gotten annoyed with the amount of prediction market stuff where that it sends to me. They're clearly trying to push it, their prediction markets. But they were kind of later to the game than Kalshi or Polymarket. So I think that that's because when you can make on the Super Bowl, I think it was like a 3x to bet on New England at some point. I looked at it, it was a 3x, right? A 200% return. And you do it in an afternoon. A kid, financial nihilism and right, all that kind of stuff. They're going to look at that and go, well, okay, so I could do that, or I could buy Bitcoin and maybe it goes up 70, 80, 90% over the next 12 months, or whatever, 18 months, 24. It's just a totally different, risk reward calculation, I think, when it comes to prediction markets. So if Robinhood and Coinbase can kind of develop the prediction market side, I think that they could do okay. I'm pretty bullish on Robinhood, kind of just generally speaking. But that's a view I've had, way back before the run. So I didn't hold any hood equity, but yeah, I think Robinhood, like over a long period of time, over a long time horizon, will probably do well. I think the company is pretty well run, and yeah, I've been a customer and just kind of seen firsthand how they operate, and I think that I think it's a good company. I just you look at a chart like this, and it looks like there's probably more downside. Probably, if I had to guess, I mean, it could also be a short-term low, but my bet, generally what I've noticed with markets with earnings is that a lot of times, like, you'll be looking at the chart, it'll indicate a particular direction, and the earnings come out to justify that move. So, going back to Coinbase, this looks like it wants to make that kind of lower leg, that sharp lower leg lower, and bad earnings or guidance that disappoints could be the fuel or the justification or the excuse for it to happen. A lot of times, once you've stared at enough price action and enough charts for long enough, you can kind of see those kind of, not always, right? Like, a lot of times I'll look at a company that has earnings and can't really tell. But in the case of Coinbase, if I had to guess, I wouldn't trade it. But if I had to guess, earnings are probably going to not come in great.
Yeah.
If I had to guess.
Dude, we'll see. I mean, we still got some time. Like, people are talking about, I believe, I don't know if it was in the stream I did with Thomas or if it was one with Joseph, but we obviously have Kevin Warsh coming up in a few months. And so people are like, the markets are trying to price in what they think about that. They don't even know if that's confirmed yet. And then when it gets confirmed, they're going to have to price in how they really feel about it, now that he's really there. And they're going to have to price in when he makes his first couple of big decisions on whether they like it or not, and if he's being controlled or whatnot. So I think we've got a pretty volatile year ahead of us. I mean, what are your thoughts going into 2026? Like,
I think that concern about Kevin Warsh being hawkish is like way overblown. I think that I don't think, wow, now it's stacked down 1.6. So sometimes I just can't get it out of my head. Opportunity, when I leave so much on the table, it like bugs me all day. The rest of the day until I go to sleep, it's just nagging at me. Yeah, I don't think he's going to be as hawkish as people think. I don't see how he is going to. No, I mean, leaving aside the political calculation, and kind of, I can almost guarantee that a deal was made, a promise was made to Trump to behave in a certain way to get the job. But yeah, like, you look just mechanically, like, for example, people are talking about a comment he made years ago about the balance sheet and how it's too large at 6.5 trillion, how it I think he had thrown out like 3 or 3.5 trillion in those comments. It was years ago. Number one, views change, people change, conditions change. Number one. Number two, if you look at how it actually works, what liability are they going to decrease? Because just, we saw what happened when they tried to, QT, bank reserves were declining here. This was when I was doing a repo video every single day, right? Liquidity was getting tight. SOFR spread started to widen. Well, the basis trade is responsible for buying 40% of all new U.S. Treasuries debt issued by the government over the past couple years. So that basis trade can't be allowed to fail, because if it does, then half of the demand for U.S. Treasuries goes out the window. So you can't let the basis trade blow up. And in order to do that, you can't let the repo market blow up. You can't let SOFR get, unmanageable and dislocate. And in order to do that, you can't allow bank reserves to decline. And what we saw was, a prolonged decline here, kind of late July was kind of when I started to flag it. And it continued until the reverse management purchases came in, that announcement in December, where the Fed was printing bank reserves. That's the money they control, the dollar supply, the money printer that the Fed has. That's bank reserves. Well, they started printing those to buy short-dated U.S. Treasuries. That is what they call RMPs. That is kind of the liquidity, the quasi QE. Instead of buying long-dated U.S. Treasuries, they're buying short-dated. That's when we saw that kind of 2.9 trillion for bank reserves was kind of when things started to get a little touchy. Well, we're there now. So it's like what he's going to engage in quantitative tightening again, which mechanically means some liability has to go down, whether that be the TGA right now at about 900 billion or bank reserves at 2.9 trillion. Something would have to go down a lot, right? And we know they can't let the base trade blow up, because that is literally almost half of new U.S. Treasury demand is being absorbed by the basis trade. So they can't let that blow up. So you can't let bank reserves go down much lower, probably than 2.7, 2.8 trillion. You can't, there's no reverse repo anymore, right? It's empty, 2.4 billion. It's basically empty, the reverse repo. So can't draw that down. And the TGA has to have a buffer of 5 days worth of expense for the government. And we have so many T-bills being redeemed every 5 days, about $600 billion worth of T-bill redemptions every 5 days, $500 billion. So if the government shut down completely, like real actual, something happened for 5 days, we would have to have $600 billion just to, because remember, we never pay off debt. We roll it, we refinance it. There's some, we issued a bond a year ago. We don't pay that bondholder back with like tax money or something silly. No, of course we don't do that. We issue new debt. And so in order to handle the amount of redemptions, the amount of bonds that are coming due over just a 5-day period, they have to have $600 billion. So quantitative tightening is just not going to happen. Like, maybe I would give this probably a 10% probability, but maybe you see the balance sheet decline to 6 over a longer period of time. But again, like, I just don't see which liability they can reduce, even that, right? Because you're talking about $500 billion. I don't think the TGA can decline much more than it has, just due to the huge amount of T-bills we're rolling every 5 days, 10 days. So you can't do that. You can't touch bank reserves. You can't let those decline too much more, maybe a little bit more, but you saw what happened in the repo market when it got to 2.8 trillion. So yeah, I think the balance sheet is not gonna go down. It might go down a tiny bit, but I think if anything, we see the balance sheet continue to grow, just as it has been. If you zoom in, we have seen kind of a low in the balance sheet, and it started to grow again with those reserve management purchases, where the Fed is printing money, using that money to buy T-bills. Asset side goes up, but liability side also goes up as well. It has to, double entry accounting. So I think that we see on the balance sheet side, I think we see that continue. There's kind of this emerging school of thought that bank reserves and the balance sheet should grow in line with U.S. GDP. If GDP is, as Atlanta Fed says, 5%, then you probably get a balance sheet that grows 5%. It's not flashy. It's not 2020, crazy amount of money printing, right? It's not that, but it's just stable growth and normalization. Now, if we start to go into a recession, you're going to get another, huge spike. Now look, he was bearish in the GFC. He was at the Fed, and he was, kind of like well into that, the GFC kind of developing. He was pretty bearish. He was like concerned about inflation and that sort of. If a crisis happens this time around, he is not going to have that view. They're going to print so much money. The situation is so much different than it was back then, with regard to leverage and interest expense, a number of areas, the kind of pro-cyclical deficit, all those things. It's a totally different situation. So you get in, it's already going to grow, kind of baseline case. If you do get economic weakness, we've seen some hiccups with labor market data recently. Nothing super severe, but if you do get an economic contraction, a recession, the balance sheet is probably going to grow quite rapidly. And then on the interest rate side, it's kind of the same story where you just have to look at the incentives, which is right now the average interest rate on the marketable debt that is out there in the world floating around is 3.3. This is that interest rate. So you look at all the interest or all the debt and the interest rate kind of averaged out. It is 3.3. Well, there's nowhere right now where you can issue at 3.3 or below. What that means is interest can only go up. So you thought 1.2 trillion is crazy. That can only go up. As interest goes up, that means that the deficit is going to go up. It's going to pressure the deficit in the wrong direction, meaning more bonds must be issued to keep the lights on, right? So you can kind of get into a vicious cycle. We have to arrest the interest. We have to stop it from growing. Right now, it's growing at about 15% year-over-year growth rate. That is unsustainable when your GDP and your tax revenue is only growing at 4 or 5. And so they have to arrest that. And the way to do it is to get interest, issue debt or refi debt below 3.3. Well, the long end is not going to cooperate. The long end has gone the opposite direction since the Fed started to cut interest rates back here September 2024. The 10-year went up and to the right, 30-year up and to the right. So you're not going to get cooperation from the long end. The only way to do it is to issue at the short end and basically finance your government and refi, constantly roll all your debt in T-bills every month, 3 months, 6 months. It's a very, kind of emerging market sort of thing. It's very dollar negative. I don't think it's going to help bolster the dollar. With Kevin Warsh, you have all these dollar bulls that are coming. Oh, see, the dollar is going to rip higher. I don't see how that amount of T-bill issuance is bullish, especially when you factor in the real rate, which is got to be negative, meaning that say inflation is 3. Well, the real rate, the inflation adjusted rate, has to be negative in order to kind of get us out of this debt situation. So what that means, inflation will be 3 or 4, and you'll probably have a 3-month T-bill yielding 1 or 0.5, right? Because then you're guaranteeing that the bondholders, whoever are buying those T-bills, they're going to get paid back every dollar they're owed in nominal terms. But in real terms, after adjusting for inflation, they're going to lose money. They're guaranteed to lose money. After World War II, the real rate, the peak of the real rate was negative 15%, meaning that if you bought bonds back then, as a way to de-lever coming out of World War II with debt to GDP at 110%. The way we got out of that was we forced bondholders to take a negative 15% loss guaranteed to inflation every year at the peak. And so that's what they'll do again. And, number one, issuing so many T-bills, that's going to be very dollar negative. Cutting interest rates further, which I expect them to do. Again, they have to get at least below 3.3. I think that they go further, especially if you have labor market weakness. I think that they go further than say 3 or 2.5. I think they go further than that, but at least the base case has got to be to get below 3. I think 3 and below for the next 12 months. It's all but guaranteed. They have to do it. All you have to do is look at the incentives, which is the interest expense and the deficit, and kind of what's going on there. You just have to look at that, and that tells you where interest rates are going to go. You can also watch what the 2-year is doing, right? The 2-year leads the Fed. The 2-year, before every rate hike and cutting cycle, the 2-year always leads. So if you're worried about interest rates, look, he's not going to hike interest rates when we're issuing so much of our debt in T-bills, because that would blow out the deficit. Because we're rolling our debt every 1 month, 3 months. If they hike rates, Well, now our interest expense is going to grow even faster. So they're not hiking rates. Like, people need to tone down the like hawkish concern. He's not going to be some crazy hawk. I've been saying this since he was nominated. And I think, I think there was kind of a knee jerk reaction right at first. Dollar
Agreed.
rallied, gold and silver sold. But yeah, I think, I'm starting to see people kind of realize, oh, that was probably an overreaction. He's probably not going to be that hawkish.
I was going to say, you've been very consistent. You and a couple others have been very consistent with that thesis there as well, ever since the beginning. And I agree. We basically saw an enormous, I guess we'll see what happens, but that's a pretty accurate picture to paint right there, honestly, from what I saw on crypto Twitter as well and some of the spaces. By the way, I know, Robert, I know you have to go here in a second. Is there any last things you want to throw in there, or last bits of data, information you're looking forward or want to pull up here before we sign off?
I mean, ISM came in quite nicely. That was last week, both on the services and the manufacturing side. We got JOLTS. I don't think there was anything like super notable coming out of JOLTS. We do have unemployed people back above total job openings. I would just remind that is the norm. What we saw recently, where job openings were above the unemployment level, that was the exception. So just, context there. Yeah, JOLTS, and we got initial claims, which did come in higher than expected. But again, like, the context is important, which is initial claims are still very, very low. This chart goes back to the 1970s. Initial claims are very, very low. We got non-farm payrolls, which came in a little bit higher than expected. Unemployment rate actually ticked down. And so non-farm payrolls came in hotter than expected. I would just say that, like, the thing to watch probably, and it ties into Kevin Warsh, is this productivity story. I think this now viral chart that I posted months and months ago, I think that there's something to it. Like, I think we really have to have a serious conversation about this productivity boom that we are already starting to experience. I mean, Q2 of last year, productivity, every revision came in higher than expected. Q3 as well. And it came in even higher Q3. So this productivity story is going to it's going to cause a lot of issues. It's going to cause further weakness in the labor market. And it's going to cause further inequality when it comes to kind of all the social, political stuff that I've talked about. So it's going to make it worse. And so, with higher productivity, you need less people to do the same unit of output. And so, the demand for labor is going to continue to fall. And, that's going to present some very, very tricky situations. Look, it allows them to cut interest rates more. And you're starting to hear people say that, right? Well, we're in this high productivity environment, so we can cut interest rates more than it might look like at first glance. We can cut even further because, look, all this productivity is increasing the potential output of the U.S. economy. So we can cut even more and not cause inflation. That'll be the excuse, in my opinion. It's about the interest expense. But they have that cover, right? It's kind of political cover to cut, despite the fact that assets are screaming higher at all-time highs. You have inflation basically at 3, closer to 3 than to 2. They're going to cut interest rates. The balance sheet will probably continue to grow at a healthy rate. Look, if we do get weakness, which is totally possible, it's not my base case, but it is totally possible that we go into a recession. It will just force them to print even more money. So again, for me, like, I think the next year, I'm not super concerned because my time horizon is 10, 20 years out. But yeah, I think just continue to expect volatility. I think that's probably the safest bet.
Yeah, that's a good way to put it. Yeah, that chart is insane, dude. The enormous run up right after ChatGPT. I remember when you first showed me this. That feels like forever ago. When you first showed me that, I was just like, we might be cooked. We might truly be cooked.
Yeah, look, there's people pointed out there are other things that start to happen. Obviously, if you look at the Fed funds,
that chart is insane.
I think that it's not 100% causative, but I think that there is a story with this that we're going to need to have a serious conversation about, because what happens when 30% of the white collar workforce is unemployed?
Exactly.
And
it's going to be a big topic of discussion at some point.
Yeah, and then how do you fund that, right? Well, the only way I see to fund it is to tax the Mag 7 which are the only thing kind of holding everything together, tax them at a very, very high rate. So then you start to, okay, well, how's that going to, what effect is that going to have on the stock market where everyone's 401k is, right?
Yeah.
So it's going to raise some kind of tricky situations coming up here.
I'm actually glad that some of like the commodities have run and that we have options like crypto as well and Bitcoin, because it might create an opportunity for people to say, okay, there are maybe other asset classes I should be. I never really thought about investing in oil. Never really thought about looking at copper. Never thought about Bitcoin and all these things. Like that might be the opportunity where they're like, maybe I need to diversify away from just companies and like, we have
tech companies.
Yeah, especially the tech companies, and then the government taking a shareholder or a stake in certain companies as well. Like we're in unprecedented territories. I'm not sure what to expect. But I'm glad
expect volatility, I would say, for the next year. Yeah.
Good way to put it. Well, listen, Robert, I know you gotta bounce your version to another stream, so I won't hold you any longer. Thanks for coming on, dude. As always, man, these are fun conversations, and I hope people learned something. Lanny was in the chat, so Saucy and a couple others in the chat. Appreciate you guys for tuning in. Everyone else who tuned in with us. Definitely, if you enjoyed this discussion, you want to see more of this type of stuff, hit up Robert. We tagged him right above us. If you're watching on X, if you're on YouTube, his X account is down below in the description. He's also got his own YouTube channel. He posts a bunch of amazing stuff. Be sure to follow him along, and we'll hopefully, we'll see you guys in the spaces. We got another space coming up in like an hour or so, talking real world assets, tokenization. We got the Trader Talk discussion, and so a whole lot of stuff coming at you from Wolf Bitcoin. Definitely be sure to follow us along if you enjoy these. We put them out each and every day. We're trying to get to 100K as well, and we're trying to get Robert to 100K subscribers. We're trying to get Wolf Bitcoin to 100,000 followers. Robert, your X is at like
34.
Trying to get Robert to 100K. Like we're trying to crack 100K. One of these accounts has to get there. So help us out. Yeah, man, we'll see you guys all in the next one. Have an amazing rest of your day. Take care.